All right. Good evening, everybody. This is part two of the two-part option selling class hosted by AP Arlissa, aka AP. So she did a great job last week with part one, which is available in the Zoom call recordings channel under the learning resources section of our Discord. She gave a full overview of herself. She introduced herself, talk about who she is, where she's from, what she's about. So we got to know our friend Arlissa a little bit better. She also gave a great introduction about option selling, kind of talked about, what it is, gave us some pros, gave us some cons, talked about who is it for, who should be using it. And in this class, she's going to give us a little bit more detail into some specific strategies that we can use to start making some money. So Arlissa, AP, if you want to do a quick recap about who you are for maybe anyone who hasn't seen the last class, I don't expect you to do the full one again because that is available in the recordings, like I said, but you just want to give a quick introduction again and then kind of go ahead and take it from there.
All righty. All righty. Good evening, everybody. Good evening. Good evening. I am Arlissa Pinkleton. Of course, everybody calls me AP. Here I am the educator to trader. And I got that name because I am an educator. I am a mathematics teacher. I've been teaching math for the majority of my career, even though I'm an engineer. So I'm an engineer turned math teacher turned trader, even though I'm still operating as a math educator. So I've been trading for about 3 or 4 years now. I started about the time everybody else seemed to start, the 2020, 2021 span of time. And I started off learning how to trade options as a seller because, seller was very straightforward. I thought maybe there was some more stuff I was missing. So I went over and learned how to buy options, and I made some money, lost some money, made some money, lost some money, decided I was going back to the seller space. So I started selling options. I've been selling options, basically developed a strategy, fine-tuned a strategy that we could use over and over and over, all the way up until volatility got crazy. And then that strategy had to be adjusted again. So I am going to talk about that strategy toward the end of this session because it is a strategy that can be used every single day in the afternoon, like at 2:30, 3 o'clock, and you can run it every day and generate profits on a daily basis. And I would say, secure, sure profits. Nothing's ever 100%, but you could definitely get, based on the knowledge that we have here, could make that work for you. So I'm a mom, I'm a grandma. I have 2 children that are my biological children. I have 5 children that are my stepkids, and I have 25, 26 maybe great grandkids. No, I have 26 grandkids. We have 26 grandkids. I actually have 1 biological grandchild, and we got 10 or 12 great grandchildren. So I am nanny to a bunch of people, a bunch of little people, and they're not all little because actually we got grandkids that are adults and got kids of their own. But that's me. I decided to join with Impact Investments because I wanted to expand my own knowledge and ability. So I came over here so I could learn more, you know, technical analysis and learn a little bit more about buying because I am a coach. I coach a community called Educator to Trader. Hopefully you all have followed me on my YouTube channel. My YouTube channel has over 8,000 subscribers. Woo woo! It just crossed over a couple days ago. That's why I'm excited about it. But yeah, I have a whole community that we do all the trading strategies that I am going to share with you today. All right, so let's get into it because it is going to be meaty. So, you're going to have the ability to, you don't really have to take notes because I will share the PDFs with you if you'd like of me to share that. I can do that. Of course, we're going to have the recording. So, I mean, you can take notes. I do talk fast, and I know that, but I also am going to try to be mindful of your time. But this is a lot of meat. It's going to be a lot of meat. So, but I will try to, and if whatever questions you have, please put those questions, into the chat or say, I got a question, and then I'll, pause so that we can make sure that you get your questions answered along the way. Along the way, we're going to get our questions answered along the way. Okay. All righty. So our option selling strategies, this is part two of our training class. Last week we did the intro to option selling. As JT said, we talked about all the who should, who shouldn't, when should, all those good things. What does it include? This week we're going to get into the strategies that you talk about. Well, there are 3 main strategies. There's variations of these but really what it all boils down to these three strategies. There's covered calls, there's cash secure puts, also known as selling puts, and there's credit spreads. Credit spreads, right? They're called vertical spreads. Sometimes they're called vertical bull spreads or vertical bear spreads. There's a few different names, but basically you need to know that it's the credit part because you're going to get the credit. You're going to get the money when you enter those trades. So I want you to keep in mind the overarching thought for selling. Okay, so the overarching thought for selling is when you are selling, if your trade ends in the money, you're going to have to perform what you said you do, right? When you're a buyer, you buy a call, you buy a put. At the end of the time, you know, if you made money, you close out the trade and you get the money basically. And if you lost money, you close the trade and you just lost some of the money that you paid. This is the exact opposite for selling. When you're selling, the money comes to you. If your trade ends in the money, then you're going to either have to release shares, whether if you have them, you're going to have to release them, or if you're doing puts, you're going to have to receive 100 shares. Okay, and we'll talk about what that really means. But as a seller, you're saying, I'm going to do something. I'm going to do something. So let's talk about covered calls first. Okay, selling calls or covered calls is a bearish or a neutral position. One thing I also want you to do is kind of disconnect your mind from what you know about buying calls and buying puts, because when you're a seller, you're doing the opposite thing, right? And this is where a lot of people kind of get mixed up, because if you learn how to buy first, of course, then you know buying calls means you want it to go up, and buying puts means you want it to go down. But when you're selling calls, you want it to go down. It's the opposite of buying calls. All right. So selling calls is a bearish or a neutral position, right? You need 100 shares for each covered call contract that you're going to sell. If you don't have 100 shares of the particular stock, then you can't do a covered call on that stock, right? You collect a premium when you enter this trade. You're basically taking your 100 shares and you're using your 100 shares as a cover for you to sell a call against them. You collect the premiums, almost like loaning the market your shares, kind of, sort of. You're going to select a strike above current price and above your cost basis. So let's say you bought, you know, I think TJ was talking about he has Palantir in the $8 range, right? Palantir is now in the 20s. If JT said, TJ, I always get them mixed up. If TJ says he was going to do a cover call against those Palantir shares, he would want to pick a strike above the current price, which is $26, which automatically is above his cost basis, which is $8. Right? But sometimes that can be upside down. Let's say he's got shares and maybe he bought Palantir shares at $30, right? But current price is 26. He would need to sell a call above his cost basis. And the reason is, if your trade is in the money, when it's all over, you're going to have to release those shares. All righty. The price has to expire below your strike price in order for you to keep the premiums and to keep your shares. If you want to keep the shares that you're using for covered calls, price has to expire below your strike price. So if you pick 26 for the strike price and price expires above 26, then you're going to release your shares to the market for that 26 strike price that you selected, right? You're not going to release them for the current, the price of whatever it is. You're releasing them for the strike price that you decided, I'm willing to release these shares at this price. That's what that contract says. If the price expires above your strike, you're going to keep the premiums. Either way, you keep the premiums that you got at the beginning, but the 100 shares are going to be called away. And all the calling and the movement of shares happens after the market is closed. So you don't have to worry about, I'm partway through the trading day and you look up and your 100 shares are gone. No, it doesn't work like that, right? All the transfer, the assignments, or all the pieces, exercise, and all that happens after the market has closed. All righty, that's what covered calls are. When are you going to sell covered calls? You're going to sell them when you have 100 shares that you'd like to sell for break even or for a profit. You can say, well, I got these shares. I'd like to release them for at least break even or to get a profit off of these shares. You can also be in a situation where you have shares and you want to keep them, but you want to make money off them while you keep them, so you don't want to lose them. In that case, you maybe pick a different strike price to make sure you may, get beyond resistance, so you can make sure, or at least, have a good, reasonable thought that your shares won't be called away. You wouldn't want, like, for example, I'm gonna use the TJ example. If he bought them at $8 and some change, and he decides he's gonna sell covered calls, if he was selling covered calls at the 26, then he's gonna get them called away at 26, which is gonna be $18 more per share. Yes, but if he wants to hold them for a longer term position, then he'll need to make sure to pick a strike their price does not breach, or he needs to buy them back. Because you can buy, you can buy to close this trade. You don't have to sit idly by and let your shares be called away. You can buy to close this options contract. And if the options contract is closed, then your shares won't be called away. You also will sell covered calls if you want to trade the wheel strategy. And I've got a graphic a few slides away that's going to talk about the wheel strategy. But basically, it's where you sell puts, then you acquire the shares, you sell covered calls, and then you release the shares, and it goes like a wheel. I'll show you a graphic soon that shows you what the wheel includes. And there's people who use the wheel strategy as a whole strategy. That's what they do all the time, is they sell puts, get the shares, sell covered calls until the shares get called away, and then they start all over. You can also do covered calls when you have dividend stocks, right? That can make, you can make, well, what is it? You can make covered calls premiums and dividends off the same asset. So if you have 100 shares plus of a stock that gets dividends, you can sell covered calls against it, pull in premiums every week or every other week, and collect your dividend. The shares, of course, are the asset, and you can use them to your advantage. You can use your asset to your advantage. How do we sell covered calls? We select a strike price at or above your cost basis, like I said, and above current price. You're going to use the bid column. You're going to collect your premiums. The money is going to be opposite of buying. What you do when you're selling is you want to sell high and buy back lower if you're going to buy it back, or you can let it expire worthless. Worthless is a good thing when you're a seller. It's not a good thing when you're a buyer. If we want stuff to be worthless and we want it to be out of the money, which is definitely not what buyers want in the money, and they want it to be worth something, right? The money is opposite of buying, though. You're going to sell high and buy back lower if you decide to buy back. You win the trade if the strike price is below your strike at expiration. You can buy to close at any time. And covered calls can be done in a cash account if the shares are in that account too, right? If you have a cash account and you are holding your shares in that same account, you can sell covered calls. You can't do like you say, I got my 100 shares is in my IRA account, but I want to sell covered calls over here in my cash account. You can't do that. The shares and the covered call have to be in the same place. All righty, but it can be done in a cash account. I know we got a lot of people who use their cash account solely. The pros to covered calls is it's a great way to profit from your assets, which is your shares. And it's a very passive strategy. There is no watching that is required when you're doing covered calls. Basically, you pick a strike. You can put on an alert if you want, if the price is starting to get too close to your strike, and you can always buy to close if you need to, or just let it go worthless, right? It's quite passive of a strategy. The cons to trading covered calls is your shares can be in danger of being called away if the price expires above your strike. If the price expires above your strike. Of course, the way you can counteract that is you just buy to close to avoid releasing them. If you want to keep your shares, you're like, I want to keep my shares, so you buy to close the trade. I'm not as much a fan of the buy to close on covered calls because I feel like I already paid for the asset. I don't want to pay for to keep the same shares. I already paid for them one time. So in that case, you definitely want to make sure that you're selecting strikes that are beyond resistance or beyond where you believe price is going to go. How much does it cost to buy to close? Well, you're going to buy to close whatever it's worth. So if the price has gone up past your strike price, it's probably going to cost more than what you received in premiums. So if you sell a covered call and you take in $30, $40, $50, whatever the amount happens to be, depends on what size stock you have, what is the value of your stock will determine how much money you're going to make in call premiums. Above that, you're gonna have to pay whatever that trade is worth at the time if you want to buy the close. And that changes, of course, based on the shares, based on the stock, based on various things. But you have to buy to close for whatever it's worth. Just like when we buy options contracts now, we buy it at what it's worth. Right? Same thing happens with buying to close on covered calls. Okay? That was covered calls. I'm going to move on into puts. At the end of puts, I'll answer some questions there. Cash secure puts, commonly called selling puts. You all probably have heard people talk about selling puts, right? What are cash secure puts? Well, they are it's a neutral strategy, right? It's a bullish or neutral strategy. I call it a no-lose strategy. Of course, I was on Facebook and called it no lose, and somebody came out the woodwork with all their answers and the reasons why it ain't really no lose. So I'll explain my thoughts when I say it's a no-lose strategy. I call it no lose because you either win with the premiums. If you sell puts, you're either going to win the trade and get the premiums, or you win the trade, you get premiums, and you get the shares. The reason I say it's no lose because at the end of this trade, no matter what happens, you're going to end up with something. Right. We've traded so many things where at the end of the trade, if it don't go your way, you can literally end up with nothing. You can end up with no money, right? Or nothing at all. If you trade, you're selling cash secure puts, you're either going to get the premiums or you're going to get premiums and 100 shares. Right? You collect a premium when you enter this trade, and that is max profit. Just like with covered calls, when you decide you're going to take premiums for your trade, that's your max profit. You're not going to make any more than you decide to accept for the trade. It's almost like if you decide you're selling a pair of shoes and you're going to sell them to somebody for $50, you can't, after they have the shoes, be like, well, I really think I want 75. You can't do that. Once you agree you're going to sell it for $50, then that's what you're selling it for. All right. That's the way the selling side works. Cash secure puts are used to acquire shares at a desired price or just to generate income. Some people use selling puts. You're going to pick a lower strike price, a price lower than the current price. Maybe it's a stock you'd like to have, but you don't want to pay what it's worth right now. You're like, I might want some, we can stick with Palantir. I might want some Palantir, but I don't want it for $26. I'd rather have it for $24 or $23 or $20. Then I'm going to sell puts at the place where I'd like to buy the stocks. So the shares. So if the price does come down here, I'm fine with taking on the shares at that price because I was okay with that price. Or you can sell puts just for income. And if you get to where your strike is going to get breached, then you can buy to close again. You can always buy to close. I would suggest that you only sell puts on stocks that you don't mind owning, because the possibility of owning them is there. It's not necessarily high or low, but it's present. The possibility of owning the shares is there. It doesn't ever happen until after the market closes. And it has to be, your strike price has to be breached, but you can end up with the shares, right? When are you going to sell puts? You sell puts when you want to acquire shares at a lower price, or you want to capitalize off of the bullish movement as a seller and collect premiums. Those are the times when you would sell puts. You believe price is going up. It may not go up hard and fast, but you know it's going to stay above you feel like it's going to stay above the strike you pick. You can do it and just collect premiums. You can just do it and collect premiums. How to sell puts. We're going to select a strike at or below current price. You're selling a put below current price. The collateral required is the strike price times 100. So if we're talking about Palantir Steel and you want to sell puts for the $20 strike or the 20 strike, you're going to take that 20 multiplied by 100. That's $2,000. That's the collateral that the broker is going to block away from you for, while this trade is going. The reason the broker is blocking away that $2,000 is to have the money there to perform the trade. If something, if the price drops, it's into your strike price and we get to expiration, that money is sitting there. So if you need to perform if you need to buy those shares, then you're going to have the money set aside to purchase them. All right. You win the trade if the price is above your strike at expiration. If your strike is here and price ends up here somewhere, then you won the trade. You won the trade. Now, if price, your strike is here, but price goes through your strike and it's below your strike at expiration, then 100 shares are going to be put into your account. The broker is going to use that money, that $2,000 that was blocked up buying power. The broker is going to use that money to buy your 100 shares, right? This can be done also in a cash account. You can do cash secure puts. The point is you need to have the cash to cover the buying power for the trade. If you want to do this in your cash account, you can do it there as well. The pros to selling puts. Selling puts is even more passive than covered calls. Literally, it's especially if you're doing it on a stock that you don't mind owning. You pick a stock, you pick a strike, you turn on the trade, and at the end of the week, or the end of, most likely it's a week. At the end of the week, if the trade, the price stayed above your strike, then they just release your buying power and you going about to the next trade. If price ends below your strike, you're going to get the 100 shares. And if you were okay with getting the 100 shares, then you get the 100 shares. At any point, you can buy to close the trade. You don't have to stay in it till expiration. If the price has moved enough for your trade to be worth nothing, worthless or worth less than you took in premiums, you can always buy to close it. You can buy back for $1, for $2, for $5. I mean, it all depends on what you took in for premiums, but you can buy it back at any time. The cons to selling puts, though, is this. This is the only time I think there is a drawback to it, is if the stock just tanks. Like if the stock tanks, then you can be left holding the bag. But you will still have an asset. You will still have shares. Now, this is why I say you should do shares on a stock that you want the share, that you don't mind having the shares, right? If you're selling puts on something like, we'll stick with Palantir, I'm there, I might as well keep using that one. If you want the shares of Palantir at $20, if the price comes down to $20 and below, then you get the share, you get the shares for $20, and you're okay with that because you didn't mind having them for $20. If you trading something you don't want, like I don't necessarily want that. If you don't want it, then don't do cash secure puts. All right. Or be sure to close your trades before expiration if your strike has been breached. All right. All righty. I'm pausing here for questions. This is a graphic for the wheel strategy. Basically, you start with selling puts. Right? You earn your premium. If it gets breached, you end up getting the shares when you get assigned, right? Then you have the shares, you can sell a covered call against them. Sell a covered call, you're also going to get a premium. At some point, you may be assigned, which means your shares are going to be called away. I think it may be the other way around, exercise. Either way, your shares are going to be called away at the strike price that you select. So you're not going to lose out if you have 100 shares at $10 a share, and you do a covered call at $12 and they get called away, you're going to be given $1,200 for something you paid $1,000 for. So you're going to still profit. That's why I say make sure that you sell above current price and above your cost basis. So if your shares do get called away, they're at least called away for you to get a profit or a break even. You definitely want to do at your strike price or at your cost basis or higher. So that way you always end up with a profit. All right. What questions? So sellers and buyers want the opposite. Yes, sellers want to be out of the money. Buyers want to be in the money. Sellers don't want strikes, the stock to be at their price. What is my preferred or recommended strategy? I'm going to come to the credit spreads. Those are my preferred. Now, I like cash secure puts. I do like them. What I don't like about cash secure puts is they require a lot of collateral. So if you wanted to trade something like an Apple, right? If you wanted to sell cash secure puts on Apple, they're what, $140, $150 stock. They may be even higher now. I don't know. But you pick a strike. Let's say you pick the 140 strike. You got to multiply that times 100. So you're putting $14,000 for each contract that you want to do a cash secure put on Apple or $140 stock. And that's a lot of collateral and buying power. So that's what I don't like about the wheel strategy. But if you've got the capital to do that with, and you don't have the time, to watch your stuff, then cash secure puts would be the way to go. Yes, it would require charting from the standpoint of if you know you want to acquire the shares at a certain price, then just work with that strike price. But if you know you don't want the shares, then you should chart for support and you should pick a strike below support. You should have some stuff between you to make sure that price will hit it and hopefully bounce and won't come down into your strike. Okay, Josh, you said for selling cover calls on dividend stocks. For dividend stocks, I mean, you do want to chart for resistance there as well, because you want to make sure that if you're trying to keep them, you don't want the price really to get up as high as beyond your cover call strike, right? If you're trying to keep your shares. You're trying to keep your shares. Let me see what I see in the chat. So buyers can only snatch your shares before expiration if your trade is in the money and it's after market hours. So you don't have to worry about, 2 o'clock in the afternoon losing your shares. That won't happen till after 4 o'clock. And it's only going to happen after 4 o'clock if your trade is in the money, right? Usually it happens on Fridays. It happens on expiration day or over the weekend. Okay, so buyers can't necessarily just snatch them unless your trade is in the money. Khalid says, I'm asking for a friend as well. We had a debate. I was telling her, I think buyers and sellers want opposite. She told me I was confused. When you say want opposite, I'm not sure what you mean by want opposite. We do want different things, like sellers want the price to be out of the money. Buyers want it to be in the money. Sellers don't want the stock price to get to their strike, and buyers do. Sellers take in premiums, buyers have to pay the trade. I think those are opposites. I'm not sure what your friend was saying as far as opposites, but those are opposites. Okay. Any more questions? I think I answered the ones I see. Okay. Ask your friend to look me up. That way we can clarify any misunderstandings. That's what happens with a lot of people with selling. It's different than buying, and many times it's basically the law of first mention. The first thing you learn is what sticks with you, and when somebody brings you opposing information, you're like, nope, my brain won't take it, because your brain is already doing what you did first. Makes sense. We have to reprogram. Yeah, or you have to just intermix the programming. We have to intermix it. All right. Credit spreads. Now, credit spreads, I am convinced that credit spreads is the best strategy on the planet. I think it's one of the best strategies. It's not the best, but I think it's one of the best strategies on the planet. And I'm going to tell you why. Okay. What are credit spreads? Basically, credit spreads is when you are selling a contract and buying a contract simultaneously, which is called a spread. There's two pieces. There's a sell leg and a buy leg, or a sell contract and a buy contract that happen at the same time, right? The bought contract is used for protection because, like we talked about, when you're selling calls, you need to have 100 shares. Or if you're selling puts, you need to have the money, the collateral that's going to help cover that trade. Well, when you do credit spreads, that buy contract is your cover. It's your cover for the call. It's your cover for the put. So it's a way to do selling cover calls without shares. And it's a way to sell cash secure puts without the, times 100 for the collateral. Put credit spreads are a bullish move. Just like selling puts is bullish, right? And call credit spreads are bearish, just like covered calls are bearish, right? Again, remember, this is the opposite of buying. The collateral required is the width of the spread. The collateral is the width of the spread. So if it's a one spread, then it's the collateral required by the broker is the $100 minus the premiums you take in. So I'd say $100 because it's easier just to understand it that way, but it's $100 minus whatever premium they gave you. If you entered the trade as a one spread, the broker gives you $25 in premium, then 100 minus that 25 means you're really only putting up $75 of collateral. Okay. Okay, Khalid, definitely. You can put us a voice text in there. That'll be great. A 2.5 spread is $250 of collateral. A 5 spread is $500 of collateral. So I'm going to change screens real quick because I want you to see what I'm talking about when I say what the spread looks like. What do I mean by the spread? Where are you? Okay, there we go. I'm back. Trying to see the new share. So I can show you what I mean when I'm talking about a spread. So this is SPX, and we're going to look at this more closely later. But you see that the difference between, I'm going to put it back on single, because usually as buyers, you all look at it as singles. Single 5 to 5, 51.20, 51.25, 51.30, 51.35. There's a difference of 5 between each of these, right? That makes it a 5 spread, because if I change it to vertical, you're going to see that now this vertical trade is 51.10, 51.15. Not sure if y'all can see that. Let me see if I can make it a little bit bigger, but it's a 5 spread, right? I'll change look and feel to a little larger. That maybe be a little easier to see. SPX is a 5 spread. There's several others that are 5 spread, right? Some of them are even 10 spreads, depending on the size. It's usually based on the price of the stock. But we know that SPY or SPY is a 1 spread, because each strike price is only one apiece, one apart. Boom, boom, boom. That's 1 spread. So when you see it as a vertical, you see 500, 501, 501, 502. You can widen your spread. You can always make it wider. You can't make it any smaller than it is on the onesie, but you can widen. You can say, okay, well, I like 501, but I want to bring down the bottom number to 499. And there's reasons for why you would do that, but you can widen the spread. You can't shrink it. All right. 1 spread is SPY. There's also some, I'm only picking AMD because it's top of mind, not because it's necessarily a great thing to trade. But you have, not AMD. Actually, I'm thinking AMC. Come on. AMC. There's lots of other ones. Like I think BAC and several of the airlines are all 50-cent spread. Notice the difference between these is 2.5, 2.53. These are 50-cent spreads, which means these only require $50 of collateral. This is why I think I say that credit spreads are really a great strategy, because they don't require a whole lot of collateral, but you get to take in 10, 15, 20% in returns, like right off rip. Now, we do know that when we are trading, sometimes during the day, we're hoping for 20%. We're hoping for 30%. We're, ecstatic about 50%, right? This is the same thing. You can enter these trades and you take in your 10, 20, 30% right off the bat. And then the price just needs to stay away from your strike. So there's several others that are 50-cent spreads, but a 50-cent spread, 32.5 means that it's $50 of collateral that the broker is going to block away minus your premiums while this trade is going on. You're going to collect a premium upon entry of your trade. Was that clear to everybody? It's a spread. The difference between those two. You're buying a contract and selling a contract all at the same time. Okay. When do we sell credit spreads? Well, when you believe the price is going to stay away from your strike. When you don't have time to watch for entry and exit, raise your hand. If you, like we talked last week, you're ready, got yourself all ready for your trade to enter, and you look up, by the time you go and do something and come back, you don't miss the entry. Or your trade is going, and it's done its pop and started and pulled back immediately. And you're like, I missed the exit. Yeah. Okay. Credit spreads, you don't have to be mindful of those two things really much. Those things are not as important for sure. You want to enter as prices leaving support or resistance, just like we do when we're buying. If the price is leaving support, you want to enter a put credit spread. If price is leaving resistance, you want to enter a call credit spread. That's where you're going to get the best, good premiums, is when the trade or the stock price is pulling out of the zone. Now, what happens to us though, is so many times we enter a trade thinking it looked like it's ready to move. And then what does it do, SPY, today? It just sits still, or it dances just a little bit, just a little bit, just a little bit, but it won't move. And if you got your trade on, if we had been in SPY today with today's expiration, it basically the time theta would have eaten up our premiums all day. But if you're a seller, that theta decay is working in your favor when you're a seller. Time decay is the time it can spin. As long as it's not coming to your strike, it doesn't go below your strike, your trade is good. We could have picked 507 as a put credit spread today, and as long as the price stayed above 507, that trade is doing good. And then at the end of the day, of course, it ran up upwards, which was really great. So then your trade just expires worthless. Do sellers get flagged for pattern selling, or does this even apply? Yes, if you open and close a trade of any sort, more than three of those in a 5-day window, you will get flagged for pattern day trading. But there's ways around that. There's ways around that. I'll talk about that a little bit here soon, but there's definitely ways around the pattern selling. But yes, anytime you're going to open and close three trades in the 5-day window, you will be flagged as a day trader. Oh, by the way, you cannot do, I'm not sure if it's on another screen, I'm sure it is. You have to use, there we go at the bottom. It requires a margin account to do credit spreads. You have to have a margin account for credit spreads. There's no way around that part. We can do covered calls, we can do cash secure puts in a cash account, but you cannot do credit spreads in a cash account, okay? So how do we sell credit spreads? We determine our support and resistance. This is where you definitely want to chart in this case. The sale contract strike is the most important. And the sale contract strike is the most important because that is the one you don't want price to breach, right? You don't want price to go above it. You don't want price to go below it, depending on what kind of trade you got going, right? That's the most important one. So you're going to pick a strike where you don't think price will come. You're going to select vertical, which we were looking at that a minute ago, under the spread, and you're going to click the bid column. Because if you're in the ask column, like when we're buying options contracts, we're using the ask column. But when you're a seller, you're using the bid column. Some of y'all probably didn't even know what the bid column was for. Like, what do we need this one for? The bid column is for the sellers. Okay, you're going to collect your premiums. Your trade is going to win as long as the price is not beyond your strike at expiration. Or, of course, you can buy to close it. You can buy to close your trade at any time. You don't have to worry about anything after that. You can buy to close, whether it's worth less than what you took in premiums, or it's worth a little bit more. You can always buy to close at any way. The good thing about credit spreads is you do have, even though your profit is capped, basically whatever you take in your premium, that's all the profit you're going to get. But your losses are also capped. You can't lose any more than the width of the spread. So if your spread is a 1 spread, price goes through it, the most you're going to lose is the $100. Your price can, drop off the map or fall off the bone, as Josh would say, and you're not going to lose any more money than that $100. Okay. All righty. So this is what I wanted to come to talk about 0 DTE. And I know we like trading same days or opening and closing the same day. We do that regularly, SPY and those kind of things, right? So 0 DTE trading is, I say, where the money and the higher risk resides. We already know that the higher risk is there because if your trade doesn't go your way in a short span of time, you have to cut it off because you'll end up with theta. You're fighting theta and price action, and you don't want to have to fight both of them. But what we do is we use cash settled equities. So using SPX, using RUT, using XSP. I think there's also one that's the Dow Jones. There's several other cash settled. What does cash settled mean? Cash settled means there are no shares. SPX does not have shares. RUT does not have shares. XSP does not have shares. The one that's Dow, it doesn't have shares, but it's not like DOW. It's the Dow Jones. I think it might be DJIA. That one doesn't have shares. So when you win the trade, you win the trade. You just get the cash. And when you don't, when the trade, you release your cash. You don't have to worry about ever getting assigned or getting exercised because there's no shares to contend with, right? Nothing with covered calls. You had to release your shares, and cash secure put, you got put the shares. None of that happens if you're working with a cash settled equity, right? You sell credit spreads with strikes where you don't think price will go by the end of the day. This is a really, really good strategy to use at like 2:30 or 3 o'clock in the afternoon. And I'm going to show you on the chart, we're going to look at a couple of why would those be why would those be good trades? Well, they're good trades because we will have seen what price has already done all day long. And theta decay or time decay is on our side. So all we have to do is pick strikes where we don't think price is going to go by the end of the day. Okay, so you can look for strikes between the 15 and 20 delta. If depending on your support and resistance prowess, you may be able to get a little closer, like arid extra dry, right? Collect your premiums for your short time trade. No shares, you're just going to exchange your cash. No shares, just exchanging your cash. Let me show you what I'm talking about here. I know when we get to 2:30, 3 o'clock, it's we're looking at capital flow, maybe for an overnight swing or something like that. But these trades, you could put these on in no time, and then you can have the chart up while you're just letting the time expire. You can just be letting the time expire, and you're going to collect your cash. Actually, you collect your cash immediately when you enter. Remember, as a seller, you get your money right away. You get your money right away as a seller. Let's look at the chart real quick. I'm just going to show you what would the chart look like today. Like we're looking at today's chart, today's price action. So if we were looking to do this at like 2 o'clock, right? 2 o'clock is up in here. We would have seen all this price action from before 2 o'clock. Right, we would have seen all this to say, okay, the low of the day was here. We opening, we got a gap up. We're here, but price is kind of just dancing around and consolidating almost all day. And then by 2 o'clock, it starts to move up a little bit. So you could say, okay, well, I'm at 230. I'm going to look at doing a put credit spread, and I will pick me some type of strike underneath the support here. I'll get some support and say, I'll do a put credit spread underneath support to let it expire. You're going to let this expire. This is how you can get around the day trade. If the trade expires on its own and you don't manually close it, then you don't get charged the day trade, which they don't close. The broker does not close cash settled trades. They don't have any reason to. So, Robinhood closes our trades at times, but that's all those. Robinhood does not trade SPX and XSP and all those cash settled. They don't have those either. So that's why they always close stuff up if it's too close for them. But the other brokers, Thinkorswim or TD Ameritrade and Schwab, I want to say that Webull has these cash settled as well. But Tasty Trades have them. You want to have a broker that has the cash settled equities that are being traded. And then at the end of the day, you're just basically going to let this go on and expire on its own. So let's say, for example, we picked the 5160. Maybe we had picked 5155, 5160. Now, so I was thinking about TJ today with his 5150. I was like, I think that's a little close. I think it's a little close, but he shut it off in time enough to not have to worry about it. But I need to clear this. I need to clear so we can see what's going on. Okay. So we're looking here. If we had done 5150, 5160, or 5155, 5160, that would have been a put credit spread. Of course, we can't see it very good here for today. Let's say if we were looking at tomorrow, because I want you to be able to see how the premiums and stuff go. We'll act like this was today, right? 5155, 5160. Okay, this is a 5 spread. So with this 5 spread, you'd be putting up $500 of collateral, right? But you're collecting $60 or $70, whatever. Once you click on the box, usually the number is a higher number. Once you click on it, you're going to collect that money in premiums right away. Right, in this case, it's $90. It's not even 50 or 60, it's $90. You're going to enter this trade. What you're doing is you're leveraging your $500 of collateral, and the broker is going to give you 90 of those dollars back right away. Right, and you aren't spending any money. You are allowing the broker to block away your collateral, like you do if you go rent a car and they, take the deposit off of you get in a hotel room, they take the deposit. That's the same thing. And when the trade's over, or when your stay at the hotel is over, they give you your money back if you didn't steal their towels and their robes. They give you your money back. This is the same thing with this trade. If you finish the trade and all has gone well, they give you your buying power back, and you keep the $90 in premiums. Well, $90 out of 500 is almost a 20% return. And all you've done is let time decay. So if you did this at 2 o'clock, 2:30 each day, hour and a half, because SPX stops at 4 o'clock. Whatever the price is at 4 o'clock, trade over, trade done. As long as the price is not coming back down to 51.60, as long as it's above 51.60, your trade is A-okay. Your trade is A-okay. The broker's going to take the $500, block it away from the buying power. They're going to give you this money right away to do with whatever you please, right? And then you just let the time decay for the rest of the day. If you decide, I want to do 2 or 3 of these, I got $1,000, I want to do 2 contracts. I got 1,500, I want to do 3. I got 2,000, I want to do 4. You're just multiplying these premiums by the number of contracts that you are putting on. All right, this is using SPX, which that's one of the big boys. So you're going to want to make sure that if you're going to do SPX, that you've got yourself good understanding of where is price. Not going to go for the rest of the day. You really can't even say, well, I want to get underneath here, 51.35, 51.40, somewhere in here. You can go out further. You will take in less premiums. But even though you're taking in less premiums, the whole goal here is to make sure that the price doesn't come back to your strike. I think I talked about doing the 10 or 15 delta. We have to put this on the single so that way we can see what the delta is. We use something too called you see probability out of the money. You see here on my screen, probability OTM. Prob OTM is basically the probability of this strike being out of the money. The probability that 51.75 will be out of the money is 59%. Probability, this is the same as delta. So if you're using delta, same concept. See, we got a 30 delta, which is about a 70 probability out of the money. It's the same thing. It's just easier to see how likely your success rate is. You want to be successful. So 81% and 80% probability. So that means you might want to pick right where we were, 51.55, 51.60. So there's an 81% chance this trade is going to be good. Those are pretty good odds. If you want better odds, you can go further away. But of course, the further away from current price you go, the less money you take in premiums. That's the same thing if you're buying options contracts. The closer you are to at the money, the more you pay for the contracts. It's the same concept, the same thing as a seller. The further away you go, the less money you take in. The closer you are to the heat, the more money you take in. Okay, I see some questions. I'm going to come answer some of those. Not the towels or the robe. Yeah, y'all take them people's stuff and then wonder why they don't give you your deposit back. Y'all already know. Oh, goodness. Okay, so you can look for your strike between the 15 and 20 delta or below support. You just really want to have, if you're doing put credit spread, you want to be below support. You're doing a call credit spread, you want to be above resistance. Many of you who are in the Blackstock Investors, I think it's Blackstock Investors, has probably seen that Randy Yancey has been posting a little bit about how he's doing SPX at the end of the day, and he's using $1,000. If you're in Blackstock Investors, you may have seen his post. Randy Yancey started doing that because I showed him the strategy. So, and then he's seen me talk to other people, and I've just taught it so many times that he started doing it. And he just does only call credit spreads. At the end of each day, he leverages $1,000 and takes in 25, 30, or 40, and then that compounds every day. You use the same $1,000 tomorrow. and you collect 30 or 40 more dollars, use the same $1,000 the next day. So you're not leaving, your money is not staying in trades over and over. Your money every day at the end of the trading day, the broker releases that $1,000 back to you, and then you use it tomorrow for something else, or you use it again for that at the end of the day, or however you did. To be, you say I did. Yeah, you use it over and over. Okay. All righty. I think I have one more slide on here. The pros and cons to selling spreads. Okay. Selling spreads, I believe, is a passive strategy. It's not as passive as covered calls and cash secure puts, but it requires a little more intervention, but it doesn't require anywhere near as much watching as buying requires. Buying is something you got to be paying attention for the entry, for the right exit. Y'all already know, y'all know all the stuff. You don't need me to go through what's required to buy. But as a seller and credit spreads, really, you just need, I don't say just, I hear people say, you just got to do. No, you don't just, there's more to it than that. But you can put alerts onto your whatever platform you use. You can put in alerts. Let's say you've got the 5160 strike and price starts to come towards you. You can put an alert on that says, alert me if price starts to get too close to 5160. If it gets to 5170 or 5165, at least alert me so that way I'll see that price is moving in my direction. It doesn't require you to watch it in order to see what happens. Now, 0DTE, what I was just talking about, if you're going to do that earlier in the day, because I have people in my community who do SPX starting first thing in the morning, and they use something called the PDT hack, and that's a whole strategy and all that good stuff. But they start earlier in the day trading SPX, and they use the PDT hack to keep them from using their day trades, or they wait till later in the day, 1:30, 2 o'clock, 2:30, 3 o'clock. You can actually enter these credit spreads at 3:59. As long as the trade picks up, you're going to collect the money right away. And at 4 o'clock, trade done. All right. So the pros to credit spreads, you get paid to trade. You basically are going to get paid a premium to trade. That is your max profit, though. Whatever that you get at the trade, that's all you're getting. The collateral requirement is low. If you do a one spread, it's $100 minus premiums. A 50-cent spread, $50 minus premiums. 2.5 spread, $250 minus premiums, right? Basically the width of the spread. You're going to win in all the situations except one. And the reason where you don't win is when the price has come into breach. I'm going to talk about that in the next con. If the price goes through your strike, then that's a situation where you won't win. Okay. You do know exactly how much you're going to profit when you enter. And of course, you know exactly how much you're going to lose. Of course, with buying, you know you can't lose any more than what you paid. So when you're a buyer, you do know your max loss. What you don't ever know when you enter a buying trade is how much you're going to profit. It could be a little, it could be a lot. You could lose and get nothing. You lose less, like you have less than what you started with. That happens too. The drawbacks or the cons to selling spreads is if price breaches both of your strikes, you're going to suffer what's called max loss. Max loss, basically. So if you have a one spread, price goes through both of those strikes and expires below there, the $100 is gone. The $250 gone. Whatever it is, if it goes through both of those strikes, that money is gone. The broker will keep it and say, no. But you can, again, close whenever you want. Or if it's in the middle of your strikes, maybe the price stops somewhere in here, then the trade is worth less than the max loss. You probably will suffer some loss, but it won't be max loss, right? The whole point is that when you're doing credit spreads, you need the price to stay above your put credit spread sell strike or below your call credit spread strike, okay? Your returns on this may feel low in comparison to buying. People say, well, that's really not a lot of money. This is true. It may feel like that, but it's quote unquote guaranteed money. They're going to give it to you right away. Soon as you enter the trade, you get that money right away. Whether you win the trade or not will determine whether or not the buying power that was blocked away is going to be released back to you, or some of that is going to be used. But sometimes people just really want to know, what's my profit? How much am I standing to get from this? If I trade SPX and I collect $90, I know I'm getting $90. and then I'm getting the $90 either way, right? They're going to give you the money. And if the trade goes your way, you get to keep the $90. That's how that goes. That's how that goes. What questions do we have? It's been like a fire hose. Dun, 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 dun.
Auntie is
Okay.
Josh here.
Hey,
Hey, you. Thank you
hey,
for
you.
I appreciate it. Can you give me a scenario where um I think you spoke about both, like when it makes sense to buy a credit spread versus what do you call it? Credit or so like a put or a call spread.
Okay.
Yeah.
So, yep, I can do that. I'm thinking about today would be a very good example of a day to do spreads. And I'm saying that because the price kind of sat still today, as far as SPX went, because like other things were moving. Netflix was on about its way, and I think Nvidia was going on about its way. But SPX and SPY just kind of sat. This is like almost perfect action for credit spreads here. You could have done, put credit spread underneath support. Price never came below there. You got moving averages to help give you some support here. And now the call credit spread part would have been more difficult because it took up and ran at the end of the day. So you could have done a put credit spread down here, and as price just kind of sat here and dangled around and did nothing, your trade was still winning. Now we know if we had entered, if you had bought a call here, anywhere in here, if you had bought a call, like we do, we have SPY calls, which they started moving a little bit at the end of the day, but all day long, they were doing nothing but just, absorbing theta. But put credit spread means you just need the price to stay above this strike price. If you had picked, let's say you picked 51.40 as your put credit spread, then as long as price was above 51.40, this trade is doing great. Okay, this would be a great day for credit spreads, right? There's some days that are, let's see if we got a hard push day. Maybe this would be a day that would be one that would be more suited for buying. The only thing is you can't see all this stuff until you're in it. You can see, okay, it's getting ready to pop. So now we can just buy a call now going up. But like Tesla this morning, it ran right on up. And then within the next 15, 20-minute candle, it came right back. Where you going, Tesla? We're supposed to be hanging out up here, right? So when you have a hard move going in one direction or the other, this is when buying really is more suited. But this also works fine for credit spreads, because if I did a put credit spread underneath support, if this was my support here, price never came back below this price. Now this got very, very close. But if I had put credit spread at like 50.10, then if I had my put credit spread under here, price never came back to 50.10.
Right.
So that trade, though there was a lot of movement, that trade was still good all day.
Yeah, that was definitely the day when Rummy Rome spoke. I could tell.
Yes, exactly. And because as sellers don't do a great, we don't like a lot of volatility. So if like earnings day as a seller, we wouldn't get in front of Palantir today as a seller. A buyer would maybe buy a lotto, buy a call or a put to see how it goes. A seller, nah, we'll wait till tomorrow, put on a sale, a sale going with the trend, and let theta help us out. There's no reason for a seller to hop in front of a moving train like that, or a possible train, not as a seller. No reason. Mm-mm. Did I answer your question, Josh?
Most definitely.
Okay.
Still new to the spread, so I gotta do some more independent research and kind of with it. But
yeah, I'm gonna tell you that the strategy of using the spreads at the end of day is a good one. Now you can use it on stocks as well. What you run into if you're running it on stocks, if you're running it on like equities, the ones that have shares, what you can run into there, depending on your broker, because stocks are going through the night. Like most brokers will shut off your trade unless you got a bunch of money in your account. Most brokers will shut off the trade because they don't know if the price is going to breach if the price of the stock is going to breach your trade at night when the options contract is off. You know what I mean? Because with SPY, even though SPY stops trading at 4:15, the options part of SPY as a seller continues until 6 or 6:30. So you can't do nothing with them. You can't do anything with that trade after 4:15, but the price is still moving. So that's why the broker will do their little risk management sweep, and you can be swept off in the midst of that. That's why we do cash settled equities like SPX and such. That way at 4 o'clock, when market closes at 4, that trade is done. You can rest assured, go have you Coke and a smile and be done with that for the day. Collect your pennies and coins and dollars and be on your way. Any other questions? Más preguntas? Okay, so I covered a whole lot of stuff, right? I covered a whole lot of stuff. And of course, everything that I talked about, all of these strategies that I talk about, they really do come with the training. Now, I'm not putting this up because I'm begging anybody or want anybody to buy anything. But if you are interested in learning more about any of the strategies I talked about, I want you to know I have a resource for you to utilize, right? If you want to learn more about the wheel strategy, there is a resource for that. If you want to learn about credit spreads in their totality, and even debit spreads, because debit spreads, y'all will see I do debit spreads a lot, which is a buying strategy. And this bundle is just spreads. I got special pricing for the impact people. And at the SPX strategy and XSP, depending on what time of day you want to do it, if you want to lean into that strategy as a whole, this is a full training on how do you use SPX every single day to make at least 10%, 20% premiums every single day. You can do that. You can go to educatortotrader.com and use impact for your coupon code if you're so interested. And if you decide, I think I want a little bit of everything, I don't want to piecemeal it. Generally, this bundle is $497, but for impact, there is a $200 off for you all for $297. Again, I wasn't bringing this up so that way I could, pimp anybody and bait and switch you. But I'm saying everything I just talked about, I talked about 4 strategies in an hour, and you already know strategies don't run. It's not quite that fast. There's a lot more moving parts, and I don't want anybody to haul off, as they say in down south. I don't want anybody to haul off and jump into something and not be fully trained on how to do it. And, I'm not going to pat my own self on the shoulder, but I'm one of the good ones. I'm going to educate you fully on how you do these strategies. And I want to make sure that you know what you're working with in a straightforward manner. Okay. All righty. Do we have any more questions? I'm proud of myself. I got done in 1 hour and 8 minutes. All right, JT, I guess it's back to you. Back to you, Jack.
All right, AP, I think I'll speak for everyone when I say that we truly appreciate your contributions over these past couple weeks, and not even just to classes. If y'all are active in the Discord, you're in the chat, you're on voice, AP definitely has a strong presence and she provides value on a daily basis. So I am excited because I know that we want to kind of continue to bring knowledge and resources from the option seller side into the group, because I want to see some more people kind of getting active. I know, of course, you do your thing kind of on a daily basis with the selling, and for the most part, the group is kind of new to this pretty much entirely. So I'm looking forward to seeing this kind of become more of a regular thing in the group. And like I said, we'll continue to kind of provide that path for y'all so it'll be easy. So we got some exciting things coming up. But again, just appreciate all your contributions. Truly, I know that this was recorded. So whenever you get the chance, just send that recording over to me and I'll post it in the Discord, because I know they're going to be blowing me up about it. So we want to get that up as soon as possible. But that's all I got. Did you have any last comments?
I don't have any last comments. Again, I really appreciate you all for giving me an hour of your time, just hanging out with me and for welcoming me in the group. It's been really good. But yeah, I'm glad to be here.
And we're glad to have you. All right. Well, we'll go ahead and wrap up the call for the night. If you got in late, don't worry. Like I said, this recording is going to be going up as soon as possible. So again, appreciate y'all for coming. Y'all have a good rest of the night.
Bye, everyone. You're welcome, Josh.